everybody. This is Tom Smith from TradeMONSTER. Why don't we go ahead and get started? Thank you very much for joining us. This is another one of our editions of our free education web that we like to host, and we have it with Chuck Hughes today. Chuck is probably our biggest contributor to free education. He provides a lot of free materials to his clients, to potential clients, people that follow him, etc., regarding different strategies. He's been in the game for a very, very long time, and I feel very comfortable in his presentations and explanations of different option strategies and stock strategies. For those of you that want to take a look at this particular webinar in an archive format, you can download it, you can play it back as many times as you want, pause it, whatever. We'll have it listed here on mytrademonster.com. Come over here to the webinar archive section. I'll have it posted tomorrow morning's time right in the June section. It will be the first one in June. If you have questions for us regarding brokerage, free to contact us. Again, My TradeMONSTER has all our contact information. We're execution full service brokers. We're experts at executing options. If you have questions regarding that, feel free to contact us. Otherwise, why don't we go ahead and get started? Chuck, are you with us?
Yeah, can you hear me, Tom?
You sound great, Chuck. Thanks again for taking the time to do this and to join us today. I'm going to go ahead and give you the presenter role, and we can get started here.
Sounds good.
It's covered now.
Okay, I'm going to click share my desktop. Can you see my screen?
We can.
I'm going to go into the show mode here. For the introduction, and thank you for taking the time to put on these educational webinars for everyone. And today we want to talk about a low-risk strategy for trading stocks and options. Okay. We'll start off talking about a low-risk spread strategy for trading options, and then we'll take a look at a strategy for trading stocks. And we'll have a Q&A session at the end of the presentation today. Risk spread strategy I've been using for a long time for trading options, and in general, they're leveraged, so they provide more profit potential compared to stock investing. But with this increased potential also comes decrease in risk. So what I'm going to do is take a look at a typical option trade, and we can take a look at the risk involved in purchasing a call option. Now is a chain for Home Depot. And Home Depot, when I took the snapshot, was trading at 77.73. And let's take a look at the August 77.5 call options, which is the money option. And it's trading at bid 20 and ask of 330. So what we're going to do is we're going to assume we're going to buy this call option for Home Depot, and we'll take a look at the risk profile for an option purchase trade. As I plug in the price for Home Depot, the option strike, and the option premium, and use my option purchase calculator to calculate the profit loss potential for this option trade. And the calculator assumes various price changes in Home Depot stock at option expiration, in this example from a 10% increase in the stock to a 10% decline in the stock. So you can see that at option expiration, if Home Depot stock is flat at 77.73, will realize a 92% loss. And if Home Depot is down 5% or more at expiration, of course, this would be a 100% loss. So we can see that along leverage that option provides, there's also that increased risk. So you don't want put yourself in a position where you're going to lose 100% of your capital. So use an option spread strategy I'll show you about that your losses to a small amount and yet does not limit the profit potential for an option purchase. So this is a great strategy for type of market. So again, a call option purchase, we can experience big losses if the stock is flat at expiration or down. If you want to trade options and you want to purchase call options, if you would be profitable, that requires that you correct about the direction of the underlying stock, but you'll have to be correct about the timing, the price move, because that has to occur before expiration. So if you're not correct about the direct end time, it could result in 100% loss, as we've just seen with the Home Depot example. I'm doing now a price chart of which is the volatility index, and this measures fear in the market. And wherever you see one of these price spikes in the VIX, that represents a sell-off in the market. Here's the current sell-off in the market, indicated by a spike in the volatility index. So each one of these represents a sell-off in the market. So you're buying call options, and at any point in here, if your timing is wrong and you get one of these market sell-offs, that results in a 100% loss on your option trade. So the strategy we're at now has been performing well in this type of market where you have these periodic sell-offs in the market. And you could call this the market neutral strategy because we take a position on both sides of the market. We take a bullish position and we also take a bearish position. And this market neutral strategy provides us with the increased profit potential with option trading without the high risk. And I'm going to show some examples of Chuck recently. Maximum risk for these option trades was 8 to 8% of 100%. So the most I could lose on these trades was around the 6 to 8% level. At time, the profit potential, as you'll see, is not capped with these market neutral spreads. The market neutral spreads allow us to take a low risk option position in a stock that's already had a large move, and I'll show you several examples of that. So a lot of these stocks in various sectors have had large moves recently, and I'm going to show you a way that you can participate in these price uptrends with very low risk. Market neutral spread is created by purchasing a call option and a put option. So it doesn't require that you short an option. And with the market neutral spread, if you have a big down move in the stock, that can result in a large profit for the market neutral spread. And examples of that. With this strategy, you don't have to worry about putting in a protective stop for your option. You don't have to worry about bad earnings reports or big moves in the stock because you're protected by the put option. So it's a very risk way to trade options. This is a daily price chart for Home Depot, and we can see over the last year, Home Depot's had a pretty big move, and it becomes, if you want to take a position in Home Depot, how do you do it after it's had such a big move? and still have a low risk trade. If you enter down here, of course, you're ahead and you don't have to worry about it. But if you wanted to if you missed this big move in Home Depot and you want to take a position now, market neutral spreads are a great way to participate in this move with low risk. So what is the Home Depot 6 call at 1875? This is a copy of my broker confirmations here, and you can see that I purchased the 6 call 1875, and then also purchased the Home Depot 80 strike put at 312. So buying this 60 strike call and buying the 80 strike put market neutral option spread, and of course the call option profit as the price of Home Depot stock increases, and put option profits as the price of Home Depot stock decreases. So this is what I call a market neutral spread, because you have a bullish position and a bearish position. So let's take a look at the profit potential for this spread I created last week. And what it is, the stock price of Home Depot and the call strike that I purchased, the 60 strike call in the pre-1875, and purchased the 80 strike put at 312. I used the market neutral calculator to calculate profit loss potential for this spread trade, and assumes various changes in Home Depot's stock at operation. In this example, from a 40% increase in the stock to a 50% decrease in the stock. And the calculator calculate the profit loss based on these assumed moves in Home Depot stock. So see that if Home Depot stock flat or decline %, maximum loss would be 8.6% for this spread. And also, even maximum loss is 8.6%. You can see if the price of Home Depot stock increases, that profit potential is not capped. So, a percent move in the stock results in a 21% increase, or 21% option profit, and a 30% increase in the stock results in a 93% return for the spread. So your profits are not capped as the stock moves up in price, but you're capped, and we can see that the maximum loss with the spread trade is 8.6%. And if Home Depot stock takes a big drop, they also can profit from this spread. As we can see, if a 40% drop would result in a 49% return for the spread. So the risk with this trade is 8.6%. The potential is not capped, and as the stock moves up in price, the profit increases. This is a way to take a low-risk trade and participate in this uptrend with Home Depot stock. And this will profit even if there's a down move in Home Depot stock. So your timing could be wrong, and you do your 8.6% loss, and then you can enter another trade at a later date. So the idea here is, if your timing's wrong, you just take your 8.6% loss, and then you move on to the next trade. And with this type of spread, you don't have to worry about playing a protective stop your position because it's protected with the put option. You have to worry about bad earnings reports or big down moves in the stock. You simply buy the spread, you hold to expiration, And if you're wrong, you just move on to the next trade. Use the prime select three-step process for selecting these market neutral trades. And I'll just go through this briefly. Within trade select, we use a three-step process to stocks and options with the best profit potential. And step one is we use my trend following system to determine the price trend. And then step two is we want to confirm that price trend and determine the extent of the buying or selling pressure for that stock and isolate the very best profit opportunities. And then step three is we use the Kelvin channels to select a low risk entry point. So go through this process to select stock and option trades with the best profit potential. So step one is we use my trading system to determine the price trend, and this system can also isolate bearish opportunities as well. So it's also successful during bear markets in selecting bearish positions. And the goal with a trend following system is to quantitatively measure the buying and selling pressure of a stock, and this allows us to follow the trend instead of trying to predict the trend. And this allows us to use a system instead of using decision making. The system I use is a very one. It's the 50-day EMA and the 100-day EMA. And the EMA is simply the exponential moving average. And the exponential moving average is the average price of a stock over a specified period of time with a weight given to the most recent daily bars. So we use the 50-day exponential moving average in relation to the 100-day exponential moving average. And if the 50-day EMA is above the 100-day EMA, then the stock's on a buy signal. If the 50-day EMA is below the 100-day EMA, the stock's on a sell signal. So prime select to select the Home Depot market neutral trade price chart, daily chart of Home Depot, and the vertical line here are the daily price movement of Home Depot, and this blue line is the day EMA. The red right here is the 100-day EMA. So we can see that the EMA blue line is above the 100-day EMA line, so Home Depot was on a buy signal. To a prime trade select is we want to confirm price trend. On any given day, there could be several hundred stocks on a buy signal according to the EMA trend following system. So what we want to do is use trend formation indicators and reach that number of stocks on a buy down to the stocks with the best profit potential. And the trend confirmation indicators I use is on balance volume, and that measures volume flow with a single easy to read line. Volume flow precedes the price movement and helps sustain the price trend. So we like to see a positive on balance volume line to confirm the price uptrend. On balance volume line is calculated when a stock closes up for the day, volume is added to the line, and when it closes down for the day, volume is subtracted from the line. And the cumulative total, these additions and subtractions form the OBV line. Here's an example. OBV line in the lower part of this price chart. And here's the price chart for Home Depot stock, these vertical lines. We have the blue line as a 50-day EMA. We see that's above the 100-day EMA, so it's on a buy signal. But we also confirm this price uptrend with the OBV line. And we can see in the chart here that the OBV line is sloping up. So we're not interested in the numerical value of the OBV line. We just want to see it sloping up, firm this price uptrend. Another confirmation indicator we like to use is the new 52-week high list. And I've discovered over time in years of trading that stocks that make this new 52-week high list are in a very powerful uptrend, and they tend to continue their uptrend. So we like to focus on stocks that are making a new 52-week high, and this allows us to firm the price trend and then to further narrow down that list of buy stocks to stocks with the greatest profit potential. So simple, stock doesn't make this new 52-week high list unless it's in a very powerful price uptrend. So this is a great way to firm the price uptrend. And another daily price chart of Home Depot stock, and we can see from the movement that Home Depot stock has been making a series of new 52-week highs. So this again confirms this price uptrend along with an upsloping on balanced volume line. Third step in our Prime Trade Select is we use the Keltner channels to select a low-risk entry point for our trade. And it's especially important if we're trying to enter this trade after the buy signal has already occurred. So this the buy signal actually for Home Depot was prior to the time frame depicted on the chart. So it must have been in 2011 or early 2012. So it's been on for a long time. So if you enter this trade after the buy signal, do that is to select a low entry point using the Keltner channels. And Keltner channels can help us select trade entry and exit points. Also provide high probability buy and sell signals. They can also help us select option strike prices. And also, another way I use these Keltner channels is it allows me to focus on stocks that have a repetitive and predictive price pattern, and I'll show you some examples of that. The price chart for Home Depot, the vertical line here are the daily price chart or daily movement of Home Depot stock, and I have the three Keltner channels overlaid the daily price movement. And we see the upper channel is this blue line here. The middle is in the middle here, and then of course we have the Keltner channel, with this lower blue line. And this is calculated as center line, the dotted line, is the 20-day exponential moving average for the stock, and then the upper and lower channels are 2 times the average true range of the past 10 days, drawn at equal distance points from the middle line. So these Keltner channels are good. They basically as an overbought, oversold indicator, and we can see when the price movement of the stock is up near this upper channel or above it, that's the stock is getting overbought, and it's usually going to correct after being overbought. And we can see the stock got overbought here, corrected, overbought, corrected, corrected, overbought, corrected. So using the stock gets overbought, it's going to retrace back to the middle channel or the lower Keltner channel. And so, and the stock becomes oversold and it gets down near this lower channel, then that usually sets up a rally in the stock. So you can see the stock will move back up to the middle channel or back up to the upper channel. So we can see it got oversold, rally, oversold, rally, oversold, rally, oversold, rally, and we're currently the middle channel, and it got down near the lower channel here last week. So seeing right now that Go is somewhat oversold, and this is probably a good entry point if we get back into the stock as it raced near this lower channel and is trading near the middle channel. The idea is stock is trading near the upper channel or above the upper channel. We want to buy. And if the stock is trading, retraces back towards the middle channel or the low, that usually sets up a good buying opportunity because it's getting oversold. The other uses for these Keltner channels is it allows us to focus on stocks that have repetitive and predictive patterns, and just simply avoid the stocks that have no clear trend. And what I did is I showed the price chart. This is Johnson & Johnson. You can see that the price movement of the stock is very repetitive and predictive. So when the stock gets up above the upper channel, it retraces back to the middle or lower channel, and when it traces to the middle or lower channel, it usually rallies. So it has a very predictive price pattern opposed to the lower chart, which is Alcoa. And we can see there's really no clear trend here, no clear predictive price pattern. So I'll simply avoid stocks like this, and I'll just focus on stocks like J&J. And this makes my life much easier and to eliminate stocks that have no clear trend and just focus on these ones with repetitive price patterns. Here's another example. This is for Kellogg. You can see a very predictive, repetitive price pattern here. The lower chart is FCX. Again, no real clear trend. You really can't get a feel for where this stock is going next, so I just simply avoid stocks like that. There's too many good opportunities like Kellogg to focus on rather trade this type of a stock. Whirlpool, again, a very repetitive, predictive price pattern versus really no clear trend. There's no reason to even try to figure out where this stock's going. So again, the channels are very useful in helping us just focus on the stocks that have these repetitive price patterns. So a look at the healthcare ETF, and we can see that it's on a trade select buy signal. And the EMA, we can see right here the daily price movement. The 50-day EMA is above the 100-day EMA. That's not displayed on this chart. This is a Keltner channel chart, but know that the 50-day is in fact above the 100-day. We can see that the healthcare a series of new 52-week highs and balanced volume line is sloping up. So here's a good example of the healthcare ETF being on a prime trade select signal. I created a marginal based on my trade select process for the healthcare ETF, which is symbol XLV. And I have a copy of my brokerage confirmations here, and you can see that the 30 call at 1348, I bought the 49 strike put at 37. So this created a market neutral spread. I took both a bullish and a bearish position in the healthcare ETF. And the market neutral calculator profit potential for this trade. And again, this assumes various price changes in the healthcare ETF. In this example, from a 40% increase in the price to a 60% decline in the price. And we can see that the maximum risk for this trade is 5.7%. And again, the profit potential is not capped. If the healthcare ETF continues to increase in price, then our profit potential continues to increase. And allows us to take a low-risk trade in the healthcare sector. It's in a very strong uptrend right now. So this allows us to establish a position in this healthcare sector with a maximum risk of 5.7%. So even if we're wrong, at option expiration, we can take another position. We can just take our 5% loss and then move on to the next trade. So, and again, we don't have to worry about placing a protective stop or big moves in the ETF because we have the put option protection in place, and that protects us. And also, if there's a big down move in the ETF, that would all profit. And more example of a market neutral trade I took. This was for Her Foods and HSY. You can see daily price here is in a price uptrend. It's making a series of 52-week highs, and we have an upsloping unbalanced volume line. So this quality is a buy signal using the prompt trade select process, and had established a market spread trade for Hershey. And my brokerage confirmation shows that I bought 65 strike call at $23.97, and I bought the 90 strike put at $2.64. And if you notice, these prices for these options are odd numbers: 2.64, 23.97, and the reason these are is because I use a option spread trade for this spread. And if it's an option spread trade, it allows me to save on the commission and also on the bid spread. I can usually split the difference between the bid cost of a spread trade, so I can save on both the commissions and the transaction cost. And that's how I wound up with a odd number in the price on these options. One more example of the profit loss potential for this market neutral trade, and the maximum risk on this trade is 1%. Again, the profit potential is not capped as the stock moves up in price. So as the stock moves up in price, we can see that our profit potential also moves up in price. A big down move in the stock, of course, would also result in a profit on this spread trade. So again, you don't have to worry about placing a protective stop with this type of position. You don't have to worry about bad earnings reports. You don't have to worry about big down moves in the stock. You're fully protected with the purchase of the put option. So let's summarize the advantage of these market spreads. The market neutral strategy provides us with an increased profit potential available with options which are leveraged with a high risk. And we saw several examples where our maximum risk was in the 6 to 8% zone instead of risking 100%. And at the same time, the profit potential is not capped with these market neutral spread trades. It allows us to take a low risk position that's already had a large move, and we saw in the case of Home Depot in the healthcare sector and Hershey's, they already a large move, but with this market neutral spread, we can take a position in these various stocks and sectors that have already large move and still have a very limited risk entering this trade after a large move. The spreads don't require shorting an option, and a down move in the stock results in the spread. And we don't have to worry about protective stops, bearing reports, or moves in the stock. And I think market neutral spread trade recommendations with advisory service, and I'm looking at the current open trade profit results for these market neutral spreads. We have a $30,000 open trade profit and an average return of 246% with the market neutral trade. So if you want to get updates on the of these various strategies, you can just log on to optionalert.com, click trade results, and then it'll display the trade results for the various strategies, option strategies, including the market neutral portfolio. Talk about a low risk strategy for trading stocks. And we have a market neutral strategy stocks that allows us to invest in stocks with very low risk. And we can limit our stock trade to as little as 1% to 2%. And I'll show you some examples of recent stock trades I took with very low risk. And at the same time, the profit potential is not capped with the market neutral strategy. And here's a chart of the VIX index, and again we can see the spikes in the VIX index. Each one of these represents a market sell-off, and if you a stock and you have bad timing in this type of a market, then you get stopped out of your position if your timing is not correct. So the strategy we'll discuss now allows us to enter trade with very low risk, so the timing of when you enter the trade really isn't that important. So let's talk about market neutral stocks. It's also known as a married put. And put strategy allows us to take a low risk position in a stock that's already had a large move. I'll show you some examples of that. And the put spreads is created by per stock and purchasing a put option, and it doesn't require shorting an option. So purchase the stock, that's a bullish position, and when we purchase the put option, that's a bearish position. So this is another so-called market neutral type trade where you have both a bullish position and a bearish position at the same time. And you have to worry about placing protective stops with this married strategy. And you don't have to worry about bad earnings reports for the stocks or big down moves in the stocks, because your position is protected by purchasing the put option. So it's a very low risk way to invest in stocks, low stress, low way to invest in stocks. And I'll show you some examples here of recent market or married put trades I took in stocks. And here's a daily price chart of the Vanguard High Yield Dividend ETF. And see, this has had a very strong move over the past year. Very, very powerful uptrend. These dividend-paying stocks have been doing very well in this low interest rate environment. And what I did was I took snapshot from Yahoo Finance of the top 10 holdings in the Vanguard Dividend ETF. And we can see the top 10 holdings include ExxonMobil, Microsoft, GE, Chevron, JA, AT&T, Procter & Gamble, Pfizer, Walmart, and JP Morgan. So the ETF is full of these high dividend-paying stocks and been performing very well in this type of market environment. And these stocks are actually still undervalued even after this big move, because the average trailing 12-month PE for the stocks in this ETF is 13, and that's not forward PE. That's the trailing 12-month PE of 13. So these I consider as still undervalued. A dividend which helps in downturns. It helps put a floor under these stocks with the end. So a very low risk way to approach the market. We can see that these dividend paying stocks have been doing very well over the past year. So the question is how to enter this ETF with a lot of risk, still participate in the upside potential of this ETF. So it was I took a married put position, and displaying my burnout confirmations here, and you can see I bought shares of the dividend Vanguard Dividend High Yield, which is symbol VYM. Bought 200 of the shares at 772, and then I also bought 58 strike puts at 135. So I have both a long position here and short position, and this allows me a low risk way to enter in the stock dividend paying sector. In spread order actually to enter this trade. Here's a snapshot of the order I entered to use to enter this married put trade, and it allowed me to save on the commissions and also bid-ask spread between the stock and the option. So I typically use these spread trades to save on transaction costs. And this is a shot of the married put calculator trade, and this will calculate the profit loss potential for this trade, assuming various ranges in the ETF, in this example from a 30% increase price to a 60% decrease in price. You can see that if the is flat at an expiration, or 20% or 40% or even 60%, highly unlikely, but just put these in here just to show you that the maximum risk for this trade is only 1.1%. So that's a very low risk way to enter this sector. And again, if you're wrong about your timing, then you can just move on to the next trade. You take your 1% loss and you move on to the next trade. So this is a great low risk way to invest in stocks and ETFs. So with married put, my maximum risk was 1.1%. The potential is not capped. As the stock moves up in price, the profit increases. So we can see if the has a 10% increase in price, spread will produce an 8.2% return. A 20% increase in the stock price results in 18% spread profit. 30% increase in the ETF results in a 27.7%. So you can see we give up a bit of the potential by using this spread trade, but at the same time, the limits, and in this example, to just 1.1%. So that's a trade-off I'm willing to take. I'll take a little bit less profit potential. Example, if you get 20% price increase, you get an 18% return for these spreads. So you have a slightly lower profit potential with the spread. That's the cost of the spread, but also gives you peace of mind knowing that your maximum loss is 1.1%, and you don't have to worry about placing a protective stop, bad earnings reports, or big down moves, because you know that your risk is only 1.1%. So if you have bad timing with this trade, you just take your loss and move on to the next trade.
Chuck, interrupt you. I apologize. So if we can go back to that screen, you're going out about 5 weeks on that. We have a lot of questions regarding time duration. You typically work with weeklies and go out, it's on the monthly.
With the married put trades and the market neutral option spread trades, I only go out. I normally use monthly options, and I'll go out 1, 2, or 3 months, or even longer. And I would mix up the duration to diversify my portfolio. So to answer your question, I use the monthly options, and I'll go out anywhere from 1 to 2 to 3 months or longer. And the prime trade select trade selection process to select these married put trades, and we can see from the price chart of the ETF that it's been making a series of new 52-week highs, and also have an upsloping on balance volume line to confirm this price uptrend. And then we can see that the ETF is retraced down towards the Keltner channel, so that is a good buy point, a low risk entry to get into this sector. So the prime trade select to help select these trades. And let's take a look now at the healthcare sector, and we can see from this price chart, again, this is another sector that's been having a very strong performance over the past year, and we can see recently it reached down towards the lower Keltner channel. This presents a good buying opportunity. Stock's getting oversold here, or the ETF getting oversold here. So I took another married put position in the healthcare sector. This is a snapshot of the 10 holdings in the healthcare sector. XLV, we can see J&J, Pfizer, Merck, and Gilead Sciences. So this also includes biotech stocks, which have been performing very well. In this price performance, this sector has really we've been on a tear over the past year. So if you want to get a low entry and participate in this move in the healthcare sector, what you can do is married put trade, which I did, and my brokerage confirmations show that I bought 100 shares at 48.62, bought the 49 strike put at 23, and of course this created a married put trade. As the spread I used to enter this position, we're buying the XV in this case, and then buying to open the July 20th 49 strike put. This is a monthly option. So we bought the 49 strike put, and this is a spread order to save on the transaction costs. And this is the loss potential for this married puts spread trade, and we can see that if the ETF is flat at option expiration or declines, then my maximum risk on this married put is 1.3%. So again, a low risk way to participate in this healthcare sector. And again, my profit potential is not capped. As the price of the ETF moves up, then your profit potential also moves up. So it's a risk way to participate in this sector that's already had a big move, but if you want to jump in now, this is a low risk way to do that. Here's one more example of a married put. This is for U.S. Bancorp stock, and we can see recently was getting above the upper channel, retraced to the middle channel, a good buy opportunity. So confirmation show I bought shares of U.S. Bancorp 565 and bought 2 of the July 36 puts at 111. The risk profile for this trade, and again, assuming various price changes in the stock, in this example from a 30% increase to a 60% decline, and we can see that if the stock is flat or declines substantially, my maximum risk is 1.5%. So I have to worry about a earnings report for U.S. Bancorp, down move, and I don't have to place a protective stop. I simply buy my stock, buy my put to protect the stock, and then just wait until option expiration. And if I just take another trade at that point. So make married put recommendations in my advisory service. Shows the current portfolio. We have $115,000 trade profit, average return of 67.3% for the married put portfolio. So that concludes my presentation for today, and I learned a little bit about how to trade the markets with very low risk. In market neutral spread strategy and the married put strategy allow you to participate in stocks and sectors that have had these big moves, and at the same time have very low risk entry. So I'm going to take any questions at this point. And again, if you want to get an update on the various stock option and spread portfolios, just log on to weeklyoptionalert.com and trade results, and you can see the performance for these various stock option and spread portfolios. So I'd be glad to take any questions at this point.
We've got a lot of questions that we're getting asked. Chuck, you referenced the 52-week high list. Do you use a certain publication that you reference that to find out that list?
That's a good question. Barchart.com has a function. If you select stocks, and then in the left-hand column, you'll see the choice, a link that goes to the 52-week list. You simply click the link, and it will display all the stocks for that day that are being a new 52-week high. And that's actually a great to start your trade selection is just start out with that new 52-week high list, because those are the stocks out there. And one stock makes a 52-week high, it tends to stay in a price uptrend, and it have many, many months of moving price once it makes that 52-week high list. So I normally check that list on a daily basis. I can also get a really good feel for the markets because I know which sectors are performing well by being that new 52-week high list. And if I see a lot of stocks in the financial sector that are making new 52-week highs, I want to that sector because it's in a very strong up move. So that's a great place to start your trade selection. Just look at that new 52-week high list and select a stock in each in maybe 5 different sectors to get your trade selection going.
According to this particular webinar you did today, this was really trying to take the stress out of trading, and I ingested it and I understand it. A lot of the clients in some of your slides, Chuck, you said we're going to avoid this particular thing because of the volatility. Do the Keltner channels viewprints it quite often? Does that make you feel that you can read the volatility based on those channels a little better for this type of strategy as opposed to using deltas or Greeks or something of that nature?
Yes, yeah, I think that simply looking at those Keltner channels, it's a very powerful tool, and I think you'll get a lot more out of that than seeing the Greeks, because it only takes a second to pull those up, and you instantly see if a stock is a repetitive price pattern versus one that does not have a repetitive price pattern. So the ones that have no clear trend and are all over the map, you want to simply avoid those kind of stocks because it's too hard to try to figure out where the next price move is going to be, whether it's up or down. So Keltner channels give us an instant picture of the volatility and price pattern of a stock, and then you can simply just focus on those stocks. I showed you a few examples that have those very repetitive patterns, and it's much better, much easier to profit when you focus on those type of stocks versus stock that has no clear trend, no idea where that stock's headed.
Sure. Chuck, with the screenshot that we're looking at right now, obviously you manage your portfolio, you manage a lot of your own assets in various type of strategies and in different accounts. With the particular strategies that we covered today, what would you say the percentage of your portfolio would be these particular strategies?
Yeah, that's a good question. Everybody has a different tolerance. So to do in my own portfolio, I trade 2 retirement accounts. I have a profit sharing plan and a defined benefit plan. So those qualified retirement accounts. So what I retirement money, so-called safe money. So that up between the covered call strategy, the married put strategy, the market neutral option strategy, and the option purchase, and the stock purchase, and the ETF purchase. So there are I use a lot of different strategies, but to answer your question, I have 20 to 30% of my portfolio in these market neutral spreads. I have 30 to 40 to 50% in the covered calls, and then the rest is a mixture of option purchases and stock purchases. And I try to limit my directional purchase trades to just 10% or less of my portfolio because of the risk involved with purchasing options. So for my risk tolerance and use my safe money in my retirement accounts, I'll let the option purchases less than 10% of my portfolio at all times, just because of the risk involved.
Now that on that, I'm going to throw this out there to you as the last question. We're getting this from numerous attendees, including Conrad Smith. I know you're a pretty risk-averse guy, Chuck, but what do you think? Any comments on the new status of the new mini options that are coming to market?
Yes, I heard about that, and that's very exciting. And that'll be a great way for the smaller investors to do these married puts and covered calls, because if you do the married put or the covered call strategy, you have to buy 100 shares of stock and then buy a put for the married put, or you sell a call option for the covered call. But with the new mini options, you can buy just 10 shares of a stock and sell a call option to create a covered call, or just 10 shares of stock and buy a put option with the mini option contract. So I think that's a great way for the smaller investors to have a diversified portfolio of both covered call and married puts. So I think it's great for the small investor, and I'm really excited about it. And I think that's the idea, to reduce the option contract from 100 shares to 10 shares. That'll allow a lot more people to participate in these more these low risk type strategies where you have to buy 100 shares of the stock.
Nice to see a little more liquidity coming to the market. I know they're only going to do it with five different positions at that time, but obviously it'd be nice. For those of you that want to contact Brad's Chuck Port staff, you can contact Brad. The toll-free numbers up there. They'll be able to address a lot of the questions regarding Chuck's strategies. They're very good at that. His portfolios, etc. Chuck, I'm going to post real quick. I'm going to take over the presentation role for one purpose only. For those of you that want to view a recording of today's webinar, we're going to post it on mytrademonster.com. I'll post it sometime tomorrow afternoon. If you give me one moment, I'll put that up there. But Chuck is pretty about allowing us to post these, so Chuck, I thank you for that. You come on by my it's up now. It will be here posted on the right-hand side under webinar. Under the month of June, you just click play, and you'll be able to go through the webinar, which Chuck just did his presentation. Chuck, I want to thank you again for doing this. I know that you're our biggest presenter and probably our biggest contributor to free education, and we appreciate that. And I hope you can come out and join us again next month.
I would love to do that, Tom, and thanks again for taking the time to up these educational webinars, which I think are very useful in explaining my various strategies and how they work. And we all appreciate you taking the time to set this up.
Thanks, Chuck. And again, as usual, thank you very much. The presentation was great. And for all of you that have joined us before, thanks for coming out again. And for your newcomers, if you have any questions, by means, contact Chuck's support staff, or you can contact us here at TradeMonster. MyTradeMonster.com has our communication up there. So thanks for joining us, Chuck. Thanks again. I hope everyone has a wonderful weekend.
Okay, see you, Tom. Have a great night.
Good night, everybody.
Hey, everybody.